The origins of HFT systems really start in 2007. Prior to 2007, if you were listed on an exchange, your stock typically traded on that exchange. So if you were listed on the New York Stock Exchange, most of the volume would occur on the New York Stock Exchange. But as technology and regional exchanges grew, the regulators saw and the exchanges saw that there were some rather large pricing discrepancies between the exchanges, so that individual investors and institutions, when they bought and sold, may not have always gotten the best bid or the best offer. So the exchanges envisioned a system wherein the best bid or offer could be automatically routed to whatever order was placed at the time. So over a period of time, the exchanges and the SEC created Reg NMS, which stands for National Market System, which allowed any stock on any exchange to be traded on any exchange, and an order would be routed to that best bid or that best offer. Now, in theory, Reg NMS is a great idea. It would guarantee to any investor at any time that they put in an order to buy something or an order to sell something, that order, rather than being executed at one price or another price, would always be executed at the best bid or the best offer. And that was a great thing, and it would have tremendous benefits for our capital market. But the regulators forgot one thing. They forgot about the speed of light, that it takes a period of time for a quote after it leaves the exchange to be disseminated across the country. It takes about 100 milliseconds or so. And this latency, which is inherent in that system, is essentially the cause of some of the problem. An HFT system initially was envisioned as a market-making tool. Rather than having rooms full of individuals on telephones, they could use machines to automatically route those bids and offers and those orders to buy stock to a single place. So all HFTs are algorithmic trading systems, but not all algorithmic trading systems are HFTs. The distinction is that high-frequency systems, especially the market-making systems, are co-located at the exchange, and they get their feeds directly from the exchange. Now, the market data that you and I see comes from the exchange, goes to a third-party vendor that then processes that information, and then that information is disseminated out to you and me and institutions around the world. Well, by default, it's already a delayed feed relative to the high-frequency trading systems that are co-located at the exchange. And these high-frequency systems rely that they get this pricing information a split second before anybody else does. So they have an inherent advantage over everyone. In the past, in market-making activities, for example, back in 1980 when I first got into the business, I worked for a company in Denver, an OTC trading desk, and we made markets in about a dozen different stocks. And from time to time, as a market maker, I would see both sides of the trade. Someone would call me up, say I've got 10,000 to go at this price. I'd work that order, and if I could buy stock at the bid and sell stock at the offer or vice versa, I would make the spread. And back then, the spreads were relatively large, certainly compared with today. So the exchanges and the SEC believed that if they could increase the time that these trades were executed, that these spreads would narrow and everyone would benefit from that. But what I see as the main distinction between market-making activities in the past and market-making activities today is that the HFT systems that are providing this market-making function are seeing these quotes long before, from a computer's time frame, long before you and I see them, and they are in effect front-running and executing these trades when there's a profit. So while I don't know for sure, because I've never had the opportunity to interview, as have many financial reporters not had the opportunity to interview the people that run these systems, it would seem to me that if they're seeing the quotes first, then the types of risks that I and other market makers were taking back in the 80s and 90s are just not the same as they are now. In fact, I think many of these systems essentially front-run these tapes and provide this liquidity essentially zero risk to themselves. And I think this is one of the reasons why you've seen such a huge explosion in HFT trading systems in the United States, and this is spreading in other countries as well. In February of 2007 is when Reg NMS put into place, and if you were to look at a monthly volume chart of the market, look at the Dow, for example, or the S&P on a monthly basis, and look at the volume, you'll see that the volume increase is literally exponential from 2007 to today. And that's not because there are more people in the market, that there's more institutions, that people across the United States are more involved in buying and selling stocks. It's because the machines are out there pushing stocks around at such great speed that these volumes are just soaring. Not so much, again, because there's more people involved, but there's just simply more machines pushing stock prices and volumes back and forth. In fact, there's a very large building in New Jersey that's about the size of 3 football fields. It's filled with literally thousands of computers. The feed is sent directly from the exchange directly into this building first, and there's so much competition, and because light has a time period that can travel through a fiber optic network, the exchanges, the NYSE, has had to put in place a system that guarantees that every computer that is in that building is getting the feed at the same time. So the computers that are closer to the feed, I'm talking physical distance of the wire, they've had to add latency so that all those machines essentially are getting the quotes at the same time. So they're the only level playing field that I'm aware of is in that building. There are rebate traders, and the exchanges and the ECNs have provided a rebate to people providing liquidity and a cost for taking liquidity. If you provide liquidity, in other words, you put in a limit to buy stock or you put in a limit to sell stock, you're given 20 cents per 100 shares for providing that liquidity. If you take liquidity from the market, in other words, you put in a limit order, put in a market order, or you sell at someone's limit or purchase at a limit, you're taking liquidity from the market. That costs 30 cents per 100 share. The exchanges make the dime. There are some systems which are called liquidity trading system, where let's say a stock is bid $20 and offered it at $20.03. If I have a liquidity trading system and someone's offering stock at 3 cents, well, if I can go in and buy the stock at 20.01 and sell it to that guy at 20.03, then I can make that 20 cents. Or if I can buy and sell off of my limits at zero profit, in other words, I buy it at 20.01, I immediately sell it at 20.01, I can make that 20 cents on 100 shares. And some systems are designed solely just to do this. People have complained about this because it enables a system to get in between their spread, take or provide liquidity from the market and make that 20 cents. And they can do it over and over and over again. So the amount of stock, even if it's only 100 shares, these systems can just click away on thousands of different stocks all day long, all week long. And essentially, if they can make these trades, the trades will go. The trades won't go unless they can literally simultaneously print them. And they just print money from the exchanges. Even though all HFTs are algorithmic systems, not all algorithmic systems are HFTs. And I believe the vast majority of algorithmic trading going on out there are on non-collocated systems all across the United States. And these systems can do a variety of different types of things, from trading ranges to trading news events, various types of strategies. There's arbitrage between stocks and options. Even though some HFT systems might be the evil beasts of the market, most algorithmic trading systems, in my opinion, are not. And they simply replace the types of systems that individuals would do by themselves. They're done with computers. Quote rates are what high-frequency and algorithmic trading systems use to influence or manipulate the price of a stock. When you and I as individuals put in an order to buy or sell a stock, we'll turn on our trading system or use our web browser to enter an order at a brokerage firm, and we'll say, buy 1,000 SPY at 135. And we'll put in a limit, for example. And then we'll turn off our program and we'll wait for that to be executed. Well, when an algorithmic or HFT system, especially an HFT system, one that's co-located, they put in up to 20,000 quotes in a single second. And a quote is an order. If you watch the quote rates, you'll see how active they are. And quote rates are potentially a very dangerous thing. Since 2007, and I can put up another graphic here, what this graph shows is the growth in quote traffic. These are 2 millisecond resolution over a 30-minute time period. So the number of quotes per millisecond are shown up here on this right column. So here's 1.1 million and here's 300,000. The blue lines represent dates. So as you go from blue to red, you're going from 10/13/2010 up to 7/14/2011. And these blank spaces in between these graphs represent the day that the CQS system's capacity was increased. So with the exception of this one period here, pretty much every time they increased the capacity, the instant they increased it, The system was already at capacity. As technology increases, these speeds increase. And as these speeds increase, the system gets saturated even faster. And the issue with these quotes and quote rates is as follows. What is the point of putting in 20,000 quote changes in a second when any one of those quotes hasn't had enough time to leave the queue, be disseminated throughout the market, and let you or I have a chance to operate on them, to take advantage of that offer or that bid on a stock? Well, the simple fact of the matter is, if we were floor traders, and every time we offered stock, as soon as someone wanted to buy it, we instantly pulled it back, and our quotes were never any good, and we would have been not only kicked off the exchange, but we'd be violating a law. It's illegal to put in a phony bid or a phony offer. Your offer or your bid has to be good for something. But yet that's exactly what many of these HFT systems are doing. They're putting out so many quotes that no one has an opportunity to operate on them. So in effect, what they're doing is creating financial spam. And what that spam does is it increases the latency in the system. It makes that delay even longer, which gives an advantage to HFT systems more than what they just originally enjoy. So here we can see we've highlighted IWM, had 3,503 quote changes, 190 trades, and 1,400 best bidder offer changes in this single second. So when we look down this list, and we'll see if we can find stock with zero, this quote right here, TBT, 1,184 quote changes, 222 best bidder offer changes, and no trades. This was an algorithm fluttering this particular ETF at that point in time at 10:58.17. Many times traders will see a big move in the stock price and they'll be attracted by the quick move, and they may jump in or jump out just because of the movement in price. Well, if you knew that a machine was pushing it, if you knew that a program was coming in and could see when it came in and whether it was buying or whether it was selling at that point in time on the basis of where the bar was going, then you wouldn't necessarily bail. If you were a smart trader, you'd be looking to possibly get back in at that position or establish a long position if you saw no additional spikes come in and breadth remained the same and your other indicators and the various charting and analytical programs that you're using showed that there wasn't a trend change at that point, that it was just a machine pushing it, then that's very valuable information for you. How many times have you gone onto your trading screen and brought up Google or another stock and you've looked at it and the quotes are just moving around so quick you have no idea where to stick your limit in, or even if you could put in a limit, whether it would get executed. So many times the smaller investors are forced to stick in market orders. Well, putting in a market order at a time when a stock is being fluttered or there's a cycle repeater running on the stock is a license to steal for these systems. And if they can cross the market and lock the spread for a fraction of a second, then they can go through and take out any limit order above or below that price. And that results in a very short-term but very brief wide swing in the price of that stock. Cycle repeaters and quote fluttering are the types of algorithms that traders really need to know about most, because they're going to have an immediate impact on the way that stock is being quoted and how it's being traded. Typically, what I've seen, especially if news events come out, you'll get a big spike. Those spikes typically reverse themselves if they're machine-driven. If they're not machine-driven, what you'll see is rather than just one big large spike, is you'll see these additional patterns show up where you have multiple spikes coming in. Those are representative not only of algorithmic trading systems, but individuals buying and selling the same security at the same time. So it will not only show algorithmic activity, but individual activity as well in the form of this background level. Nanix is a company located in Chicago that has been providing market data for a variety of participants, and they have probably more experience than anyone in terms of examining the tape and looking at quote feeds. And after the flash crash occurred, they provided a great deal of research into the causes of it and some of the problems within the HFT and algorithmic trading area.